social consequences of doing that on the people whose wealth is generated, because they may have more money, but they also have more problems. Also recognizing that you do not have trust law in Kazakhstan, but you have many successful people who, I think, from what I understand, go to Switzerland or go to Holland to have their money invested there, and to have settlements with Swiss or Dutch trustees to hold family money for the benefit of other family members. Even though your law is not the same as ours and you don't have a trust law formally here, the fact that you are trying to preserve wealth in families and generate more wealth for families on an after-tax basis, we may have certain common interests and patterns. To the extent, again, that we have a system which has been in force now for nearly 100 years, perhaps some of the stuff that I mentioned to you tonight might be useful. Because the point of the talk is, as I said, the tax actions that you might be asked to take on behalf of your clients go beyond that. And your client might find out after he has put a plan into action that it has not worked out so well for his children or grandchildren. It's rather, what can I say after 40 years of doing this, it's rather ironic that while it's an extremely interesting field of law that I practice in, at least for me, when I look at it at the end of the day, I think, well, I've helped my clients legally avoid taxes. There is more money than there would be if they hadn't come to me. There is a market for my services. But sometimes I look at the family and I go, did they really do the right thing? And I want to give you the example of a grandfather who, as I said, we help try to transfer wealth to the clients. Right now, the transfer tax rates in my state, New York State, for people who have large estates, when they die or when they make large gifts, 40% federal, 16% state. The state is deducted from the federal. The marginal rate, if you have $10 million and you want to leave it to your daughter and you die, between the $9,999,000 and the $10 million, 49.6%. So every dollar above that is taxed at, we can say, 50%. And this is a big improvement in terms of exemptions from what it existed 10 or 12 years ago. I'll give you the example of a client, a grandfather, a friend of mine, who back in the 1990s transferred money to his grandson in a trust. Everyone know what a trust is, generally? That you give money, person A gives money to person B to hold for the benefit of person C, subject to some written conditions. Well,
you can elaborate on the trust, although some people may know about it. I think that would you like to hear more about what is trust, or you know all about it?
I can flash a trust up on a screen.
Yeah.
Back when this trust was formed, you'll see it was dated on December 29th, 1989, and that looks like James Constantino's handwriting on the top line. Our client had a grandson. At the time, the exemption from federal estate taxation was only $675,000. We've had a huge increase in the exemption. Back then, the exemption was $675,000. This client had many times that amount of money. So the idea is that back then and now, if you give away assets each year, back then you could give $10,000 away free of gift tax if you filed a return. Now you can give away $14,000. But this was the first of the grandchildren, and the client put $10,000 into this trust. He gave $10,000 to his daughter as trustee to hold the money as part of a trust fund. And it says that during the time of the trust, and I'll get this, I'll work out with Tom to put this on the L drive if you want to see it as an example, that the trustee can use this money for the comfort, support, and education of the beneficiary. And when the beneficiary reaches age 21, the beneficiary could withdraw any part of the trust principal that he wished. The trustee would notify the beneficiary of that right. We'll get to that in a minute. And within 30 days, the the beneficiary, now 21-year-old, this was a little baby at the time, he didn't turn 21 until 2010, he could say, trustee, give me my money. Of course, he'd be asking his mother as trustee to give the money to him, but she would be legally obligated to give it to him. But if he didn't exercise this right, the property would stay in trust until he was 30. Now, this wasn't, nobody comes to me and says, I want to set up a trust for $10,000 for my grandchild. The cost of doing something like this, it is not efficient. What you want to get into if you have wealth in America is a pattern of giving. That if you can give away $14,000 a year free of our gift and estate tax, you do it every year that you can. And then if you have 5 grandchildren, you do it every year for the 5 grandchildren. And because you're married, you have 14,000 times 2, that's $28,000. And 5 times $28,000, I believe, is $120,000 or $140,000 each year. That each $140,000 block reduces the estate tax by $70,000 going forward. So it's really worth people doing arrangements like this with their grandchildren, or their children, or whomever, to lower the estate tax ultimately. And it's a productive, at least I think so, use of client money for legal talent, for legal expense. With adult children, the fact that there's estate tax to pay presents even more opportunities, because you don't have to necessarily set up trusts. You can give the property to the adults directly. I'll give you the example of a family called the Kaisers. The Kaisers own a manufacturing plant. Sorry about this, zooming in on Prezi. They own a manufacturing plant with a couple of locations, and they have 3 daughters, Johanna, Erica, and Eleanor. Happens to be my wife's name and my 2 daughters' name, but I'm not the Kaiser. And the Kaisers have $20 or $25 million, which even in our beaten up America in this day and age, that's a pretty nice sum of money to have. They're going to pay very serious estate tax when they die. And they approached me about having the daughters become part owners of the real estate in which the business is located. So this was a way that they could make gifts of the property, so that even though the gifts were going to be larger than $14,000, the value of the gifts would grow during the owner's lifetimes, and they could live for another 30 or 40 years, and all the growth, the delta of the growth, would be out of the estate. So instead of having a $40 or $50 million estate, they could try to manage their assets to shoot more money down to the children and less money growing in the hands of the parents. So what they did is, you have limited liability companies in Kazakhstan, a corporate-like entity for asset protection, but at least in the United States, a partnership option entity for purposes of income taxation. We have here the formation of a limited liability company by operating agreement. And what Ludwig Kaiser did is form an LLC all by himself. You can form a one-man, one-woman LLC. He formed it. He deeded 3 pieces of real estate to this. I'm using the example of real estate he had in, I call the town Kingston. And he formed a one-person LLC. He deeded the real estate to it, and then shortly after that, he proceeded to assign half of his units in his LLC to his wife, so that the 2 of them would be owners of the LLC together. So you have the value of these valuable real estate holdings held indirectly by the LLC, and then split between mom and dad. And then shortly after that, the Kaisers proceeded to transfer 49% of the units by assignment to Johanna, Erica, and Eleanor. In and you'll see the memorandum of assignment. You probably have a process like this legally when you bring people into a business. And so he proceeded with Mrs. Kaiser to have the children, the daughters, sign on to the operating agreement, in return for which each of the daughters got 16 2/3% of the business entity. And Mr. Kaiser continued to be in command. But what he did is create direct outright ownership interest in the LLC, but they were members of the LLC and not managers. So what does he have is an estate plan in which he has vested property interests in his 3 daughters. Now, are any of you knowledgeable about the famous play King Lear, Shakespeare's arguably greatest tragedy? It's about estate planning. Because at the beginning of King Lear, the king says to his 3 daughters, I want to divide my kingdom. It's time for me to give up my kingdom, and I want to hear from you daughters what you think of me. And the 2 evil daughters, Regan and Goneril, say, King, you're not only the greatest king around, but you're the greatest daddy who's ever been placed on earth, and we love you. And the other daughter, Cordelia, proceeds to say, there's really nothing adequate I can say to express how I feel about you. She was honest. Result, the king got angry. He gave the 2 daughters who turned out to be faithless and evil his money, and Cordelia was, in a sense, exiled. And in the end, the king realizes the wrong that he's done. Everybody is dead. It's Shakespeare. And, but it's an estate plan gone wrong, because here's a man who proceeded rather thoughtlessly to transfer property over to his daughters. I don't think he was tax motivated, because in mythic pre-medieval England, there wasn't actually there were transfer taxes in Renaissance England paid to the crown. But the king got in a lot of trouble with his estate plan with 3 daughters. And so this estate plan on the part of the Kaisers, arguably driven by tax considerations, nevertheless has placed into motion